Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. This week I'm going to be examining some big tech companies. I don't usually cover big tech very much, but we kind of had an unusual situation, I guess, this week where one of them, Facebook, looked like a good buy. So a lot of times popular stocks people pay a lot of attention to, big cap stocks, they never really become good values unless kind of something negative is going on. And there are some negative things going on about Facebook. If you watch the documentary about social media companies, I forget the name of it right now. It's really good. I mean, it kind of shows the business model and how that can kind of change people's behavior and things like that. When it comes to Facebook, and there's regulation and there's everything. So there's definitely some regulatory / customer backlash or whatever, but it's not really showing up in Facebook's earnings yet. I think the reason the stock price is where it's at and a little low right now is because people are anticipating a negative future for Facebook and its companies somehow, whether it's regulation, competition, all the normal things that kind of affect a business. Sometimes it's worth really thinking about those things, but usually, unless they're really obvious and sure, I go with the numbers. So Facebook's a case where the numbers still look good. The sentiment around the stock, while it doesn't look like super cheap to a value investor, I mean, we're looking at like a 22, 23 PE using forward earnings. So this is where I think a lot of value investors go wrong. Okay, Facebook has a track record of growing earnings like above 30%, basically. Now, I don't expect them to grow earnings that fast over the next 10 years. I'm estimating about 20, so because I don't ever estimate higher than that. So I am saying Facebook has a good chance to keep growing at a fast rate over the next 10 years, and that means it's worth paying a 22 PE or a 23 PE for the stock, if they find a way to do that. Now, they might not doing the exact same thing that they are now. I mean, I think they're a pretty innovative company, and they'll probably come up with new ways to make money. So, and I'm basically just making a bet on that. All right, so I'll get into the details of that here in just a second. First, I'm going to review some of the other buy ideas I've had. These are all pretty early, and we've had kind of a downturn in the market, but I always like to kind of touch in and look and see how they're doing. And then over time, as time goes on, when we get a year or two into this, we'll probably be able to see some patterns emerge. We'll see if the strategy is working or not. So let's take a look at the previous buys, and then after a short disclaimer, we'll get into the specific Facebook analysis. Okay, let's start off by looking at the previous buy suggestions that I've had. So we've only had the channel going a month now. I've had a buy suggestion each week, and then last week I had two that were both refiners. Now, as you can see, all of these are down since I suggested them. Probably the only one that is notably down, I would say, given where the rest of the market is Anthem. And this almost certainly has to do with expected regulations that are going to come from a democratic government. So right now I'm saying, things are probably not going to change, and the market's saying, oh yeah, we're worried about changes that are going to affect their Anthem's ability to continue to make profits and grow profits. Okay, so that's and then over time we'll see, over a year or two, we'll see what happens here and whether I'm right or whether the market ends up being right. And while this is down, the S&P 500 is down too, but because Anthem's down so big, we are underperforming right now by about a percent and 3/4. So again, we'll see how this shakes out. In terms of numbers, we're Principal's still outperforming, Allstate's outperforming, HollyFrontier's outperforming. So that Anthem is really driving us down. But as we get more data points, we'll be able to, over time, actually make some judgments about this. So we want a lot of data points, and then we also want some time to pass. And then we'll be able to see kind of how this all shakes out. But I want to make a habit of checking in here. So this is how we're doing right now on the buy ideas that I've shared. And in my other videos that we have out, I'll check in on the avoids and the sells when we get to the other stocks that I'm talking about this week. All right, now I'm going to have a short disclaimer and then we'll get right into Facebook. Hello everyone and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Okay, let's take a look at Facebook here. So this is a fast graph. I use this for my less cyclical stocks. The way that I judge whether it's cyclical or not is I look to see how far earnings drop when they have a decline, okay? So usually it's a recessionary decline. Now we had a weird recession this time where people actually spent more time online. Advertisers maybe spent more money online. And so you can see that Facebook had a great year this year, but they didn't this year. This is probably because they spent more money kind of beefing up their employee and adding employees and stuff to try to regulate their service a little bit more. So that's probably what caused this little decline here. But the overall trend is very fast growth, okay? Growing at 33% just using the basic measurement from when they went public to this year, which they just finished. And so this all looks pretty good. The analysts expect them to grow, I would say, upper teens going forward. My estimate's going to end up being 20%, so I'm a little more optimistic than the immediate analysts. But what I'm going to do is I'm going to shorten this because this is like a 66% growth year. This is a 100% growth year. I don't really expect those years to repeat this kind of early fast growth that they had. I expect them to grow, but I mean, these kind of throw everything off. It also traded at a pretty high PE here of like 50, 40. Okay, and that throws off my that really brings up the average PE ratio over the time, and I use that to measure mean reversion. So let's close that and get the time frame that we want here. So we're basically looking from 2015 through 2020. We're going to take what they've done during this period and we're going to try to project that forward 10 years. Okay, let's take a look at Facebook here. And I'm just going to work through each one of these metrics so I can show you what I'm looking at. Now, what I usually aim for in terms of buying a stock is I want the 10-year expected annual returns to be 12% or more, using part of it is a mean reversion expectation and part of it is what the business will produce over that time. Okay, so we looked at the fast graph earlier and Facebook is moderately cyclical because we saw that downturn, and really we know a lot of this is an ad company, and usually during normal recessions, not like the one we just had, businesses run fewer ads because people don't have as much money to spend. So I think we know pretty much, you can kind of think of it as an advertising company, and they usually do have earnings declines during recessions. So we should think of this as moderately cyclical. I don't think Facebook's really been tested to know how cyclical it will be in a normal recession. We won't find that out till next recession, and we don't know when that's going to be. So that's something to keep in mind. In some ways, my estimates could be a little optimistic because I'm not baking in a really big decline, and a bigger decline in earnings could happen during the recession. Okay, so let's start with the mean reversion. And so what I want to know there is, what happens if the current PE ratio reverts to the average over the recent cycle that we've had, okay? So the average PE from 2015 through 2020 has been 31.78. But the PE right now, if I pull up the right page, the PE right now, using 2021's earnings estimates from analysts, which are, let me show you those. So I'm looking forward now, right here, okay? So I'm assuming they'll earn 11.37 in 2021. If they do that, then it produces a PE of 22.72 at the current price. If that PE were to revert and everything else stayed the same, it would over the course of 10 years, it would produce 3.41% return per year, just from the market changing its mind and saying, oh yeah, Facebook's growing pretty fast still. We were wrong about the regulations. And we're going to value that fast growth at a 30 PE instead of a 20 PE, right? So that's what this is assuming. Again, these are just taking average estimates and kind of giving us a rough estimate of what might happen. Okay, the fast graphs growth estimate during this time, or growth measurement, I should say, during the time frame from this point up to where it's at now is 27.5. So it actually grew at 27.5% the past 5 years. My estimate, which takes into account this decline here, but also I forget how far forward I looked. So let's just see what I came up with. Yeah, so I actually had a faster growth rate at 33.85%. But whenever I'm projecting out 10 years, I never assume businesses, especially if they're the size of Facebook, that they'll grow faster than 20% per year. So I basically put a cap on this expectation. So this 20% growth expectation, in one hand, it's conservative because they've been growing faster than that, basically, no matter how you measure it. But on the other hand, it could be a little aggressive because analysts are expecting 13 and then 18 and then 18. So I'm a little higher than that, but I'm a little lower than the past. That seems reasonably okay to me to get us in the ballpark. I try to use the same method and approach unless something really weird is going on for all my stocks. So where maybe with Facebook I end up being a little low or high, maybe on the next stock I end up being, the opposite of that, and it all kind of balances out. So, but that 20% is my limit, and I basically never assume a stock will grow faster than that for 10 years. You can kind of, however you think it, whether it's reasonable or not, you can adjust it down or not. So this is how fast I think earnings are going to grow. I expect them to come in at 11.37 next year and then grow at 20% after that. So the question I ask is, if I invested $100 and it grew at 20% a year, given where the earnings yield is right now on the stock, how long would it take that $100, how much would that $100 grow over 10 years, including the initial investment? And my calculation is it would grow to $237.10. So I put that into a Kager calculator for 10 years, and it comes up with a return of about 9% for the business. So this is just if you bought the business, if you went and just bought Facebook. You could expect the business to return about 9% a year if it can grow earnings at 20%. Okay, so what I do is I take this number from the business, I take this number if the market changes its mind about the stock and treats it like it has been, like it has in the past, I put them together and then I get this 10-year Kager, and that's the thing that I really usually care about the most. Let's move it over here a little bit. And right now my parameters are, if it's over 12%, then it's a buy. Okay, so this is over 12% right now. It's a buy. I think about $265 is about where it crosses that threshold. So below that price, Facebook looks like a buy. And look at this PEG ratio. I mean, in this market that we have right now, and again, even if I change this to say, let's say analysts are calling for 17% growth, okay, over the next 3 years. Let's just use that. Or maybe we'll just even use 16. We'll go lower. All right. The PEG is still under 1.5. I mean, you just can't really find that in this market right now. The average market PEG ratio is above 3. So even if we got 16% growth instead of 20%, we're still paying half the price for future earnings that the market on average is trading at right now. So it's basically half as cheap as the market. Now the market's probably too expensive. A lot of the average stock in the market is probably too expensive. So it's not necessarily that Facebook's going to double. It could double and match the market and catch up to the market. So that often happens. But it could also be that the market sells off and the market comes down. And it could just be a mix. Maybe Facebook rises a little bit more, the market comes down a little bit more, and they kind of eventually meet down the road a few years. And that's probably what will happen. It's hard to say. The market just kind of makes up its own mind as time goes along. But some of my other checks here, 3-year revenues have grown 92%, so that's fantastic. The recession PE, I probably just picked one of the lower PEs because I didn't pick this year because it didn't really get affected. I probably picked during that 2019 dip, and if the stock went down to that recession PE, it could still fall 25% from here. So if the market starts feeling the same way it felt when it felt really, really bad about Facebook, you could still have 25% downside. That's even if earnings do what we expect them to do. So it's worth keeping in mind. I mean, you could buy the stock here. It could easily fall 25%. So you shouldn't freak out if you buy it and it falls. You just need to wait around until people change their mind, unless something is really wrong with the business, and then you can start thinking about selling or whatever. So that about sums it up. I mean, if everything goes as planned and the world was perfectly smoothly operating, you would pull in about 12% a year from this stock. In reality, usually within like 5 years or less, the market decides whether it was right or wrong, and we get an adjustment, and we either kind of make a lot of money or we don't make very much money, or we lose. We kind of know in the next 2 or 3 years probably kind of what trajectory we're on. But I think even though it's a large cap, even though it's tech, even though it's FANG, it's a good bet. Now, I wouldn't put any more money in Facebook than I would put in some unknown stock nobody's ever heard of. So this is going to be like a 1% portfolio allocation, equal weighted with any other stock I would buy. So it doesn't get any special treatment. It just gets kind of a place in the portfolio along everything else. And if it does well, it'll grow into a bigger portion of the portfolio. So we just basically treat Facebook like we treat any other stock. All right, that's my buy for the week. And I'm going to make a sell video and an avoid video, and those will be coming out at the same time as this one. Apple and Tesla will be those stocks, so you might want to check those videos out too. Don't forget to subscribe. And I try to put videos like this out every week. Later.